Let's take a viewer email right now. It's from Joe. The subject is Crescent Point Energy. CPG, please give your view on Crescent Point Energy.
Okay.
What do we think here?
So of the key themes in this market, clearly since the bottom, one of the key themes is what we call beta, or things that are highly economically sensitive, and resources and basic materials have been part of that. So this is a tricky one because it really so far is a retracement of some of the losses over the last 2 years. And historically, when you have a bust, like the tech bust or the financial crisis or an energy bust, things might go down 65 or 70%, which oil did. And they will very often have as much as a 50% bounce off the bottom as people go looking for the money they gave up on the way down. The history is, though, that typically you're going to have to go through a long period of restructuring in the industry before you ever get a sustainable rally. So I'm not saying there's not more upside in energy. There probably is in the near term. But you have to be careful not to turn a trade into your perception of a long-term investor. The people who tried to buy technology stocks in 2003 after a short burst didn't get much. Now, Crescent Point built its business on growth, making acquisitions, growing their production. They don't have a balance sheet to make those kinds of acquisitions today, to make accretive acquisitions. And so it's going to be difficult. And I think that people bought this historically for dividend growth. So I think you're not going to get hurt too badly right now. But the reality is I would prefer, if you're looking for something that's a little longer term, to look maybe at a different sector, because energy really has become mass manufacturing. They can turn on production in about 12 days, and it's 100% chance of success when you drill a hole. So the chance of oil being much above the cost of production for a long period of time is going to be tough.
Okay, let's take a call right now. Jerry in Vancouver, go ahead.
David, can you please give me your view of Bank of America? It seems to be languishing compared to the other banks. And what is your favorite American bank? And what do you think of Citi compared to Bank of America? And can you give us the street consensus, please?
Sure.
Thank you.
So let's talk broadly on banks to begin with. One of the criticisms of this rally has been that financials in general have been lagging the market until about 7-8 days ago. And the banks have had a very nice move. Coming into earnings, there was some real concern about capital markets earnings and net interest margins. And banks have come in. The numbers have been okay, but the negative view was built in. And we've had a big lift over the last few days. So Bank of America has rallied from like 12 3/4 to 14.50 in 5 days. I think in general, the U.S. banks can do better. We have some JP Morgan at Barometer. Although a lot of our financials exposure is in financial technology and things that are more specifically market related because we believe we're into a better market. So asset managers, we'll talk about one today.
Okay.
But I think that the banks look as though they've made a turn. It's not my number one group.
Interesting. Okay. As it relates to Bank of America, the analysts, 81% do rate this a buy, 19% rated a hold. Average price target is $17.30. And some of the highs on the street, FBR Capital Markets, they've got it with a $20 price target. Buckingham Research has a $20 price target on the stock as well. And the lows would be JP Morgan or so, or Evercore. Both have a $16 price target on the stock. Let's take another call right now. John in Point Pelee, Ontario. John, hi.
Hi, Miss Murray. Always a pleasure. How are you?
I'm good. How are you?
Just dandy, thanks.
Good.
I feel like my call is a bit redundant here. I was calling about the banks as well. I own JP, Wells, Citi, and Bank of America, so you've already touched on two of those. Could you elaborate on JP and Wells, please, David? You're one of my favorites. Thanks.
Thanks, John. Well, it's a timely question because we have held Wells Fargo. And I think one of the jobs of an investor or a manager is to be trying to upgrade the quality of your holdings all the time. It doesn't mean something has to be going down to be sold if there's a better opportunity. And as it is becoming clearer that equity markets are becoming more sustainable, we're more interested in having a little bit more capital markets exposure. So we recently, over the last few days, have exited Wells Fargo and moved on, and we've added JP Morgan as a new position. So the pluses for Wells Fargo, you know, the leader in mortgage, should be a beneficiary in a recovering U.S. housing market, which I think is the case. If you look at XHB, which is the home builders ETF, very clear and persistent strength since the market bottom. But Wells Fargo has been lagging, and I think part of that has to do with their net interest margins that they're receiving.
David, if you want capital markets exposure, why wouldn't you just go all in and buy Morgan Stanley or Goldman Sachs?
Well, you can do that. I mean, the numbers were expected to be very poor, and they weren't great. Stocks have behaved much better. We're going to talk about a capital markets exposure today that I think hits right dead center in the middle of a secular trend.
Okay, we're going to be back with David Burrows. He's President and Chief Investment Strategist at Barometer Capital Management. He's answering your questions about North American large cap companies. You can call us toll free at 1-855-326-6266.